The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to Nova's presentation of Secure 2.0 Long-Term Part-Time Solo K Client Training with Kim Rader and Kristen Pitman. Before we get started, I would like to point out the panel on the top right-hand corner of your computer screen. You will see a drop-down section for chat. This is where you're going to enter in any questions that you may have for Kim and Kristen. Please keep in mind that the Q&A portion of this webinar will be held at the end, and they will answer as many questions as time permits. If time does run out and you still have questions, you can email us webinars@nova401k.com. Right below chat, you will see the handouts drop-down. Here you will be able to download today's material. Thank you so much for joining us. I would now like to introduce Nova's Director of Client Relations, Kim Rader, and Nova Solo K Division Leader, Kristen Pitman.
Thanks, Yvette. So good morning, everyone. This morning we will talk about new legislation on long-term part-time employees, specifically to solo K plans. So this topic is being presented for mainly our owner-only plans. So you might be here if you sponsor a plan. So if you're an owner of a company and you sponsor your 401k plan and have that for yourself, that this presentation will be for you. Also, if you're an advisor, so we have many advisor, relationships that are intrigued here as well. So hopefully our advisor partnerships will get a little bit better understanding on how to help our solo clients with this new piece of legislation. So of course, as I begin, a little disclaimer, this presentation is general in nature and should not be a substitute for any legal or tax advice. If you do need legal or tax advice, you should contact a qualified professional, such as an attorney or an accountant. So let's get started. Our agenda here that I won't read to you, but this is all about long-term part-time employees today. So quick overview of Nova, just to make sure that you're aware. Nova is your third-party administrator for your qualified retirement. So we handle kind of the compliance, a little bit of the legal side. We handle the informational tax return for the 401k plan, and we administer your document. We do partner up with your investment provider and an advisor, if you do have one, to help service the plan and keep it in compliance. So just kind of a little bit back overview there. So big picture wise, this is like jumping right into the crux of this whole presentation. But why does this even matter to you, to a solo plan? We're going to go into detail later, but the gist of all of this is, if you have a long-time part-time employee, we'll talk about what that is later, but if you have one or more of these employees, effective 1/1/24, you are no longer a solo K plan, and many things will change for your plan. Nothing we can't work through and we help you with, but there are many things that will change that you need to be aware of, and that you need to bring in, Nova and your advisor, if applicable, into helping you make sure that the plan remains in compliance, remains qualified, and retains that tax qualified status. So, once you do change and you're no longer solo K plan, there are other considerations that we need to look at. Again, we'll kind of talk a little bit more about these in a broad sense throughout this presentation. But other considerations, so if you do have an employee and you're not going to be a solo K plan anymore, then there's different requirements. So the IRS enforces certain testing on the plan. You have to file a different 5500. So our solo K clients are able to file a simplified 5500 or none at all. But if if you do have LTPT employees that you have to offer the plan to, you have to file a different informational tax return. you have to file another form. It's called the 8955 SSA. That's a form that basically reports terminated employees with balances to the IRS. But that's something that is different when you're no longer a solo K plan. And of course, you know, this means that you must offer certain employees the ability to do a salary deferral into your plan, and they have to be given notices. So the requirements do tick up a little bit. Again, that's part of the services Nova provides, but just wanted to outline that. So that's like the big picture, the biggest picture, right, is like the consequence, or not the consequence, but you know, the thing we're going to have to deal with. If you do have LTPT employees, basically means you can't be a solo K plan anymore, and you're going to fall under some different requirements. So to recap of what a solo K plan is, again, you're probably on this call because you sponsor a plan, and you might think you have LTPT employees but not sure. To kind of recap what a solo K plan is it's basically a plan that just covers owners and their spouses. So you could have a, you know, company, or you know, you could be set up with, you know, 2 owners and their spouses, perfectly fine. We can set up a tax deferred plan for you. You can fall under what we call the solo K plan. You have simplified testing requirements, which basically means, you know, you're able to contribute what you can under the rules, and so is your spouse. You're able to file a simplified return. So if you have assets in your plan that are over 250,000, you can file a 5500 EZ, and it's basically just a shortened, you know, 2-page return that has very minimal information that's required to be filed every year. And then furthermore, if you're a solo K plan and you have assets under $250, you don't even have to do a filing. There's not one required until you either terminate the plan or your assets go above 250. So being a solo K plan does have certain advantages in the simplification of it. Of course, it goes, you know, the 401k plans are heavily regulated. And if you've kind of been out of touch with that, just want to make that statement. You know, to be a 401k plan and to be a qualified plan, there are all sorts of rules and regulations that are imposed by the IRS and the Department of Labor. Most of the rules are getting at, you know, fairness for employees. So when you're an owner-only plan, you know, not as, you know, heavily regulated, if you will, because it's just you, the owner, maybe a second owner, maybe spouses. But once we start talking about employees, the IRS and DOL's rules, you know, do uptick quite a bit. And we always kind of joke, I mean, common sense doesn't always help. Congress will pass laws and regulations that, quite honestly, don't always make sense. And then, you know, we're scrambling to try to comply. And then another thing to note, the rules frequently change. Hence the long-term part-time that we're talking about today. You know, every year, especially for the past few years, you know, there have been big regulations came out. Secure 2.0 that this LTPT is part of was a big sweeping change that came out at the very, very end of last year. So under the current law, we could draft a plan to exclude any part-time employees who never worked 1,000 hours in a 12-month period. So that's how most of your plans are written. If you're with Nova and Solo K, we kind of, you know, the maximum amount was like, you know, hey, you won't be able to enter until you've met 1,000 hours. And generally that kept part-time employees out, which kind of means that you're not required to offer them the plan. So that's been the way plans have operated for many, many years under the Solo K arrangement. Just kind of you know, if you could have a part-time employee who worked, you know, 600 hours for you for 10 years in a row, and it would never trigger the requirement that you offered them the plan. But here comes the Secure Act, and that has changed things quite a bit. Particularly Secure 2.0, you know, again, has changed it so that part-time employees must be offered the plan or offered to defer from their paycheck effective 1/1 of 24. So in a few short weeks. And why are we talking about this now? Because January 1st is right around the corner. You know, we kind of wanted to address this too, because that is a common thing, a theme across the industry. The background a little bit on this is Secure 2.0 was passed on December 29th of last year. Once that was passed, many people across the industry, you know, our record keeper partners, investment providers, TPAs like Nova, like us, you know, big employers, big industry groups, gave feedback to the IRS. When these rules first came out, they seemed on the surface very complicated and probably hard to administer. So there was pushback given to the IRS for further guidance and for maybe some relief on the effective date. There was some indication that that might happen. So, you know, we waited across the industry, you know, waited to put this into place until guidance was issued. Well, as a day after Thanksgiving gift to us all, the IRS issued the regulations on November 24th of this year, Black Friday. So a couple of weeks ago, day after Thanksgiving, the IRS released the regulations. In that regulations, there were some changes, but what was very disappointing is that there was no transitional relief. So the 1/1 effective date still remained. And so what's happening now is there's a scramble to comply. And this is across the industry. You know, I say no transitional relief because there's no formal relief. For example, the IRS didn't come in and say, oh no, it's going to start in March. So there's no official transitional relief, but, you know, we think that there's probably a little bit of a grace period, you know, where, you know, if you are trying to comply, then you know, you will be okay. You won't be, you know, penalized in any way if it's not like on January 1st, the day. Maybe it's, you know, the end of January. As long as you try to comply, and Nova will help you along with that as well, then we think you're good. Okay, so what does this change? So for part-time employees who have to end up being admitted under this law, there's a couple of things that the legislation did change. So one of the things is it was confirmed that you're not required to give an employer contribution to these employees. So, you know, for long-term part-time employees, if you do have one, you have to give them the option to make a salary deferral from their paycheck, but you are not required to give them employer contribution, which would be a match or a profit sharing, something like that. There is accelerated vesting that's required though, and that adds a whole nother level of complexity. We'll touch on what that means later on in the presentation. And then overall, it really won't affect the non-discrimination testing. As a solo K plan, you are able to get, you know, not be, you know, confined so much to the non-discrimination testing. So this LTPT will be, you know, will be okay because we don't have to include them. So if you're a plan on this call, any of these things apply, you don't have to worry about LTPT. So if you have never employed a W-2 employee who works between 500 and 999 hours per year for 3 consecutive years, then you're good. Of course, it brings up to mention that you may or may not have in the past tracked hours. So you may need to think about that. You will need to think and go back to 2021. And if there's been people who worked 500 to 999 hours in 3 consecutive years there, you might have a LTPT. But if you don't, then you don't have to worry about the rules. Profit sharing only plans are plans that actually are restricted to only employer contributions. They do not allow 401k salary deferrals. Again, like for 2023, the salary deferral limit was $22,500. It was something that that is not allowed in profit sharing plans. And then defined benefit plans and cash balance plans, these don't apply to either. Okay, getting in some of the further basics, the employee basics of this. Who is an LTPT? What does that mean? How can we figure it out? Again, the mandate came through past, further guidance on Black Friday. Who is, to kind of confirm who is an LTPT. So again, as a 1/1 that this goes into effect, you look back to the 2021 calendar year. And anyone who since 2021, January 1st, 21, who's worked 500 to 999 hours in 3 consecutive years becomes an LTPT employee. This applies to all 401k plans, even owner only, hence why we're talking today. So those are the rules as of right now. As of 1/1 of 24, it has to be 3 consecutive years going back to 2021. To make all of our lives even more fun, also the IRS said that effective 1/1 of 25, it's actually only 2 years instead of 3. So for our 2024 year, we have to go back and think, since 2021, did someone work 3 years in a row, 500 hours? If yes, they're an LTPT. Then when it hits 25, we still have to go back to 2021, but we see if any 2 consecutive years. And if the answer is yes, they're an LTPT. So we will be talking and reminding folks of this, in 2025, but worth mentioning now, this 3-year period is in effect for 24, but in 25 it changes. The rules in general about calculating years of eligible service can be particularly complicated. For example, you could have someone, if they were hired maybe in June of 22, the way that eligibility is counted could really increase the complexity, making it such that it would be possible to accrue 3 years of eligibility in as little as 25 months. And that's really depending on the date of hire. We could do a 30-minute discussion on determining eligibility. But rather than do that, the point that I want to make to you is, because we kind of look at service, the first year is based on date of hire and the second year is based on calendar year, it can get complicated fast. And so we really think that the best thing on there is really to just reach out and speak to us, to kind of, so we can have an individual look at your specific situation and your plan with you. So the recommendation would be, if you have anyone, any current employee who does work between those periods, let's talk. We do want to talk to you and look at your specific situation if it's not, clear cut. Okay, so shouldn't we already know this? If Nova's my TPA, what, shouldn't you know this? And the answer is maybe. We might know this. Every year we ask for census information from you, and you give that to us. But sometimes part-time employees just aren't reported to us because traditionally they haven't been needed. Traditionally, part-time employees who never met 1,000 hours, we wouldn't have to be concerned about because they wouldn't have met eligibility. So if you did report those employees to us in the past, we really might have your data and we might know. But if they weren't reported or ours wasn't reported, we just may not have the data. So really do encourage you to make sure we go back and we see what the hours are that the individuals work for your company. You know, we have a number of clients who just started their plan here in 2023. And so, you know, why didn't we know about this before? That's a very valid question. Again, when Secure was initially passed, there was some discussion that, you know, from the IRS that came down and came out through the industry that it would be changed and that it would be amended before it even went into place. Because, you know, it was thought that these rules are really, really complicated. They can really complicate matters. So when it was passed, we knew there'd be further guidance. So, you know, we did not want to put something in place for it just to be changed. There was the thought that it would be, you know, amended out or changed in a way, but it turned out that was not the case. And the guidance came out, like, again, on Black Friday with no transitional relief. So that is where we are now. Even for plans who just started in 2023, you know, these rules affect those plans as well. So if you do have LTPT, so, you know, again, that's kind of one of the first things we need to do is look for LTPT. You know, does this even apply to me? If you think like, well, I do have an LTPT employee, but they probably won't want to defer. You know, do these rules even matter? And the answer to that is yes. You know, unfortunately, even if they choose not to participate, even if they say, no, I don't want a salary deferral for my paycheck, the plan in its basic form will still not be able to be a solo K plan. So even if the IRS and the Form 5500 we look at has to report, you know, some people who are eligible. So even if you have someone you have to offer the plan to and they choose or they decline, you're still subject to the IRS and DOL rules and can no longer be a solo K plan. So some additional rules to talk about on long-term part-time. So you can still have the age requirement in your plan. You likely have this in your document. Again, Nova's owner-only plans typically say that, you know, non-owners are excluded, and if you did have any employees, they wouldn't enter until 21 and 1 year of service with 1,000 hours. So if you have a part-time employee and they're not 21, no need to worry about that either until they hit 21. So again, we don't even have to think about this until the employee is 21. The eligibility computation period. I touched on this earlier, but you know, it does complicate the eligibility computation period. On most of our plans, we first look at the anniversary year to see if someone worked hours. For example, if someone was hired on June of 2022, you would take that hire date and look 1 year out. So you would look at June 2022 to June of 2023, and you would see, did they work 500 to 999 hours? If that answer is yes, they get 1 year of service. But it actually switches then to the calendar year after that. So for our second period, we have to look, January 2023 to December of 2023. And if that person worked in the January to December of 23 period, 500 to 999 hours, they get 2 credits of service or 2 periods of service. So that is kind of to touch on that. Again, it can get complicated quickly, which is why in the earlier slide, if you think this applies to you, like, let us just take a peek and go over, look at your employees with you and make sure, you know, when they become eligible. But really, you look at the first period from date of hire, 1 year out, and then the second period, you look at the calendar year. But you can exclude service prior to 21. So for these LTPT rules specifically, excluding service prior to 2021, not considered at all. So exclusions. You might have an exclusion in your document. You know, you might have a specific situation. I think overall, that's not something NOVA defaults in for you. It would be, you know, a specific situation you discussed with us upon setup. But generally, plain documents can have non-service-based exclusions. So generally, if you have, like, you know, just field workers or maybe an hourly employee, you can have those exclusions in your document, and you can still have it even after this rule change. But there's kind of a caveat to it now. The IRS wants to make sure we're not disguising it as trying to keep out part-time employees. So, for example, if you have a company, you're the owner, but you have some part-time field workers, for example. So you have 3 field workers who are part-time. You cannot exclude them. And that is because it would be considered as a disguised service-based exclusion. You would not be able to exclude them because it would look like you're trying to maybe circumvent the rules and exclude part-time employees. Excuse me. Again, the excluded classes is something we can look at you, look with you at your plan, at your specific plan, and see what you have in your document, see if any changes need to be made, etc. Many of our plans do default to exclude non-owners or non-highly compensated employees by class. And so your document might say that now, you know, excluding non-owners. The question, oh, excuse me. The question is, does it get you out of the LTPT rules? The answer is not straightforward. It's maybe, but it's a facts and circumstances to your specific plan. So again, going back to an earlier slide, the IRS says you can't have an exclusion that may be disguised as trying to keep out part-time employees so we can get around the LTPT rules. So if your non-owner employees are all part-time, you won't be able to do it. You'll still have to include them in the plan. But if we say there's, you know, we could say there's, you know, your non-owner people, you know, some of them, you know, fall into a different kind of class, and it's not all of them that are part-time. You know, we might be able to exclude it. Again, those rules can get complicated quickly, but overall, if your non-owners are just all part-time, you probably will not be able to retain that exclusion in the plan, and you will be forced to offer them the plan if they meet the LTPT rules. Again, if your only quote unquote employee is your spouse, are you still a solo plan? And that is yes. So again, solo K plans are set up to cover just owners and their spouses. So if your LTPT employee is your spouse, then you have no problem. You still can be a solo K plan. So next, I'm just going to kind of touch a little bit on employer contribution investing. So if you've determined you have an LTPT employee in your plan, one of the next decisions you have to make is whether or not you want them to have an employer contribution. So if you have an LTPT employee, again, you have to tell them, hey, you can salary defer from your own paycheck. But then you have to decide whether or not you want to give them any employer contributions. The most common ones for solo K plans are a match or a profit sharing. It could be a safe harbor contribution, any other like employer contribution where the employer takes the tax deduction. You know, we have to decide whether or not we want to give that to the employee. So that is the next decision to be made. If you do an employer contribution, I just kind of wanted to point out, we're not going to spend a lot of time on vesting, but just kind of a little bit on the concept and how it kind of changed for LTPT. So most of your plans are written to allow employer contributions, meaning, you know, you can put in a profit sharing for yourself, you can put in a match for yourself. You also have the option to tie a vesting schedule to that. So for you as the owner, it doesn't matter. You're going to be 100% vested in the money you put in. But if you have an employee that you want to contribute employer contribution to, you can actually have a vesting schedule. And what that means is if the employee works for you for 2 years and then they quit and take their money, they can only take, in my example here, 20%. This here that I'm showing is the most common vesting schedule that most of our solo K plans have. But what it's getting at is, you know, if an employee works for you for 2 years, you give them a profit sharing. So you give them a, you know, $1,000 contribution in their plan from the company or from you, and they leave after 2 years and quit, then they only get to take 20% of that money, and the rest goes back to the plan to be used in the future. You know, 3 years, 40, all the way up to 6 years, 100% vested. So that's kind of just the basic on like what a vesting schedule is. This is something that doesn't come up with owner onlys, right? Because it's just the owner and they're 100% vested and the spouse too. But when you have a plan with employees, this is quite common to tie a vesting schedule to it so that if an employee quits after 2 years, 3 years, they won't be able to take all the money. So how did LTPT change this? Well, normally, and in most of Nova's plans, we consider 1 year. So, you know, back on our other slide when we said, oh, someone works 2 years, we count that as how many years did they work 1,000 hours? So, you know, we consider a 1 year period to be 1,000 hours. So if someone worked 1,000 hours or more, they get a vesting credit year. LTPT changed this though. They said, well, you actually accrue a vesting credit if you work 500 hours. So it reduced it. So if you have an LTPT employee, it's further complicated by the fact that for full-time employees, it's 1,000 hours, but for LTPT, it's 500 hours. It has really complicated things. The new rules do allow you to disregard prior to 2021, which does help, and it makes it slightly simpler. So you're only going back to 2021. But if you do tie a vesting schedule and if you do make employer contributions, this is just something that you need to be aware of and to note. into note. Nova does kind of track vesting for you, so you should know that. That Nova helps track vesting, and record keepers help track vesting too, should you find yourself needing that. So what happens if you have an LTPT employee who then becomes eligible under the normal provisions under the plan? So if they work 1,000 hours. So if you have an LTPT employee and then they switch to full-time, there's a caveat in the law that says they actually get to stay at the 500 hours for vesting credit. So this is just kind of one of those little quirky complications that you will need to watch if you do have someone in that situation. If you start out with someone who's an LTPT employee and then in 2 years they switch to full-time, you should know that their vesting might be accelerated because once upon a time they were an LTPT employee. Okay, so kind of a summary, if you will, on the employer contribution part. So again, do you have LTPT at all? If you don't, none of this applies. But if you do, then you have to document your decision regarding certain things. And you have to do that very soon. One of those things, again, is whether or not you will give employer contributions to LTPT employees. Nova will default to exclude them from employer contributions. And that's really because we don't want to assume that you want to give it to them. We're not going to default into that for you. So if you want to offer it to them and give the LTPT employees an employer contribution, you will need to tell us that, and we will help you document it. The amendment isn't required to be adopted until 2025, but you need to make the operational decision now about what you're going to do before you actually offer the plan to the LTPT employee. So basically, if you do have an LTPT employer and you're reaching out to us, this is one of the things that we will have you do, is we will have you complete a checklist documenting the elections that you've made about your LTPT. Okay, now we're going to get into the options section. Like, okay, I have an LTPT. I understand what you're telling me, Kim, about the years, and I definitely have one. What do I do? So want to kind of, try to summarize your options here, and then we'll go over each one of the options in a little more detail as far as action items under each of those. So, what do you do? Definitely reach out to us. You might already know what you want to do based on some of this, but then to move forward with those actions, we need you to reach out to us so we can help effectuate those for you. If you, don't really know that there's LTPT, first step, just call us and talk to us about it. And we'll help look at your population to confirm there's LTPT. And then you will need to choose an option, and there's the 3 options listed on our screen. You either decide, okay, I have an LTPT, then I'm gonna go ahead and offer them the plan. That's one option. You decide, or you determine, I have an LTPT. You can actually amend the plan to be profit sharing only. We'll talk about that. You could also amend the plan to be terminated, and we'll talk about that too. Okay, option 1, which would be to offer the plan to the LTPT employees. And again, when I say offer the plan, I mean you go to your employee and you tell them, hey, I have a 401k plan. You can defer your part of your salary into it if you'd like. It'll be a payroll deduction every paycheck. So one of the first things we need to do is you should talk to your financial advisor or you can talk to Nova if you don't have an advisor. Not all of our owner-only plans have advisors on them, and that is fine. But we need to understand and talk about how you're going to set up the employee account. And what I mean by that is most of our solo K clients, not all, but most, are in brokerage accounts. So it's likely that your financial advisor has set you up with an account at their brokerage house. And that is great. But you do need to start a dialogue with them because there may be some restrictions. It may be the case that the brokerage house can't set up multiple accounts, can't set up an employee account, or there may be a minimum balance required. And for employees, they're not going to be able to, they may not have that minimum balance. So, so that's why it's very important to talk to your advisor. So you either need to set up a separate account at your brokerage for the employee. So an account separate of your own would need to be set up at the brokerage firm. Or you can look at other solutions. Another solution would be with what we call a record keeper, and that's another party who basically record keeps the plan. They keep track of it daily. You go online, you can see, each employee, what the value of their account is. They hold the funds, all of that. So when you start adding people, especially multiple people, many of our clients do like to go to the record keeper. Again, the reasons kind of being, the record keeper is designed to track accounts on a daily basis for multiple people. And then two, why some of our clients go to record keepers is just because the brokerage house may not be able to set up an account for an employee if a minimum isn't met. So you should know there is some lead time to work with a record keeper, so that's not something that happens overnight, but your financial advisor paired with Nova or Nova, if you don't have a financial advisor, can help you look at options there. Nova can help, look at other record keeper solutions that may fit your plan if you're unable to set up a separate account at the brokerage firm. So once you know how your employee will be set up, where their money will go, where it will be invested, you'll need to document that. You'll need to document the elections with us. I put on plan sponsor link because it's actually done through our portal, but our service reps will help walk you through that. Again, our defaults are kind of that, we're not going to change anything regarding the plan's eligibility or exclusions. We're going to say no match or profit sharing for those LTPT employees by default. And we're going to not change your vesting schedule at all, other than to add the LTPT requirements. Excuse me. So those are our defaults. So unless you tell us differently, we're going to go with that. Another action item would be to review with us or review your plan document to see if you wanted to change anything else due to employees entering the plan. And Nova can go over other options with you that you might want to change once we talk about adding employees to the plan. So once you've identified them, and then we know where their accounts are going to go, we have to first determine where we're going to put their accounts. We need to provide them with enrollment materials. And if you're with a brokerage and you're setting up the separate account at your brokerage house, Nova can provide some samples of it's basically a form that tells the employee, hey, you have the right to defer some of your salary into our plan. What do you want to do? Do you want to do a percentage? Do you want to do dollar amount? And then how will that be invested? So Nova can can provide you samples of those forms if that is needed, but we need to provide the materials by 1/1 to them. Again, as I talked earlier, if it's not exactly on 1/1, we will, if you make your best effort to make progress and to do it, within the first part of 2024, we think that is good to remain in compliance. Another thing, an action item that, once we've told the employee, okay, employee, you want to put 5% of your salary into our plan. Well, now we have to actually effectuate that in payroll. And so the payroll provider, you'll need to then work with your payroll provider to set up a separate deduction for 401k deferrals. This is something that payroll providers are very used to. So if you work with a payroll provider, they will know that a separate deduction needs to be set up. If you do that in-house, again, you'll need to add a deduction for 401k contributions. If you're working with a payroll provider, it may involve paperwork, and that may take a few weeks. Hence, you may not be able to comply with January 1st if you're waiting on your payroll provider. And that's okay, as long as we start the process, start working with them, and then get that going and completed when they can help get it up and running. That is sufficient. Another kind of thing that's different for solo K is there is a requirement when we're talking about employees that deposits be made into the investment provider in a certain time period. So generally, that's within 7 business days of being deducted from the employee paycheck. So as a solo K plan, you might have just written 1 check a year to put in all your money into the 401k plan. Well, when we're talking about employees, we actually have to, there's a requirement that you do that after every paycheck. So after every paycheck, if employee A says 5%, I want to defer 5% of my compensation, after every paycheck, you have to take that deduction and then you have to deposit it into the investment provider, whether that's a brokerage house or with a record keeper. So again, between us, your advisor, a record keeper, we can help you with that, but it just is something to note. Further action items under that option 1 that you do have LTPT that you want to offer, NOVA will also have to update our service agreement with you. As mentioned before, when you go from solo K to non-solo K, there are additional 5,500 requirements, an additional SSA form, other non-discrimination testing that we will be providing. So there is a new fee schedule. And again, we can discuss that with you on the phone or in a scheduled call. These new fees would go effective in October of 24. And you'll also get assigned a dedicated account manager. So many of our solo K plans now are serviced by our solo K team. That consists right now of a group of 3 people. So you might have talked to one of 3 people previously on our solo K team. But when you're not an owner only, you'll have one of our dedicated account managers, so 1 person that you talk to. And then the final action item would be that you need to make sure that any future LTPT or newly eligible people be enrolled as well. Okay, so that's the first option. The first option is, you decide you want to offer it to the LTPT, and that covered kind of the action items. Okay, the second option is amend your plan to be a profit sharing only plan. But before we get into the action items on that, the very important point that you need to be aware of and that you do need to discuss with your CPA or tax advisor is the deduction. So, you know, there is a deduction limit of 25% of your W-2 income if you're a corporation, or your earned income if you're a partnership or sole prop filing on a Schedule C or K-1. So if you're a profit sharing only plan, the only thing you'll get to contribute is 25% of your earned income. So for example, if your earned income is $80,000, 25% of that is $20,000, and that is all you would get to contribute. You wouldn't get to do an additional amount for your deferrals because it doesn't exist under a profit share only plan. So potentially, if you went this option, it would reduce the amount you're able to put into the plan. So very important you discuss that with your CPA. But if you looked at that, you know, we've coordinated with your CPA, we do want to do that. There's an amendment that has to be put into place, 1-1, to remove the 401k feature. If you do want to do this, please contact us as soon as possible. You know, no later than December 22nd if you do want to do this, because we'll need to amend your plan immediately to be effective 1-1. An amendment fee will apply, but what does not apply is the LTPT rules. So if it's changed to a profit sharing only plan in 24, the LTPT rules do not apply, and you do not have to offer the chance of deferral to your employees, and the plan stays as solo. Further on that, you know, you do have to be mindful and stop any contributions that come after December 31st of this year. You can still contribute 2023 contributions, even though it's, you know, 24, but you have to stop any that are applicable to the 2024 tax year. And again, make sure and consult with your CPA or tax advisor, because it really can change your total deductions. It can change your quarterly tax estimates. It can change a lot of things, because you won't be able to put in, or you may, I won't say won't, but you may not be able to put in to the plan as much as you have in previous years. Again, the trade-off is you don't have to deal with LTPT, and it remains a solo K, but it really depends on your own earned income situation. Okay. The third option would be to terminate your plan, which means close it down and move the money somewhere else. And why would someone want to do that? Well, if someone may want to do that if you don't want to offer LTPT employees the plan, and maybe your compensation is such that you're limited in your contributions anyways. So if you're dead set on not offering it to the employee, this could be a solution for you. To do that, you have to begin a termination process. So many things have to happen when you're terminating a plan. You have to sign an amendment and plan termination paperwork. We have to freeze the plan so that no requirements happen for 2024. You have to stop making any contributions, and then we have to, or you will have to decide where you want to move your money. Do you want to roll it over somewhere else, roll it in an IRA? You'll need to talk with your advisor on what to do there. But this is an option if you just do not want to deal with any of the LTPT. A couple of things you should know about this is if you do terminate your 401k plan, you cannot start a new one for a 1-year period. So you would have to wait a year before you started a new one. You would be required to do a 5500 filing for 2024. So the assets would likely not move until 2024. So you would have to file a 2024 filing. And then the process itself just takes a little longer. So the termination process takes about 90 days to complete. So it will, go into 2024. Okay, So I feel like I talked extra lot, but I don't know that we have, I guess we will, Yvette or Kristen, do we have any questions?
We did have one question come in. Let me go ahead and read that. If Solo has part-time employee and worked 500 hours in 2021 and 2022, but only 400 in 2023, will they be eligible for 2025?
Potentially, yes. They won't be eligible in 24 because the rules for 24 are the 3 consecutive years. So if we look at that employee in 2024, and for 2024, in that example that she gave, they did not work over 500 in the 3 years. So for 2024, they wouldn't. But that is correct. 1 of 25, they would be. Because in 25, the rules changed to be 2 consecutive years. And again, we have to go back to 2021. So in that example, yes, they could potentially enter 2025.
Awesome. It looks like that's the only question that came in. So we can.
Okay, well, I think I have like 4 minutes until the top of the hour. So I'm going to go through. I don't have a lot of frequently asked questions here, but I'll start going through a few of these. And then again, if you have further questions, feel free to type them in or reach out to us, and we can get those answered for you. So some of our clients might ask, well, can I just move my 401k plan to a SEP plan or a simple plan? And, generally we would not recommend that because we don't think it actually solves the underlying problem. With the SEP IRA, you still have some of the requirements for an employee to be, eligible. So still age 21, but the employee has to have worked for the employer in at least 3 of the last 5 years and then received a certain amount of compensation that's written there. So there's still certain requirements where once they hit that minimum, you have to offer it or make contributions. So we don't really think that gets around the problem necessarily. But here at Nova, I will say we're not SEP and simple experts. We are 401k plan experts, but SEP and simple plans, if you want to discuss that further, more information, your financial advisor would be a good resource for that. For a simple plan, those plans have much lower limits. So it could impact you even further than a reduced limit on a 401k plan. So moving to a simple plan, there are requirements there. Simple plans must make employer contributions for any LTPT employees, and then they just have lower limits in general for our owners. So because of those, we think it might not be a great solution, but don't hesitate to consult with your financial advisor on your specific situation. So if you have an LTPT employee, can't you just put their money into your own account? And really the answer to that is no. It's better not to have it commingled within your own self-directed brokerage account. You don't really want to take on that liability of the investments for them. You really need to set up a separate account for them, and that would either be, having a record keeper help and the record keeper setting up the accounts, or if you're able to open a self-directed account for that person, that you work with your financial advisor and the brokerage firm to set up a separate account for each person, so that that person picks out their own investments, and that person can go in and see how much they've contributed, how much they've earned, etc. What if you have a 1099 or independent contractor? Can you reclassify your W-2 employee? This is a question we've gotten asked a few times. We are not employer law experts, so you know, we would say, you know, there are very specific rules regarding employer being an independent contractor. So you really should contact your accountant on that situation to make that final determination. You do have the slides. I'm going to skip over this. An LTPT for 5,500, they still have to be reported. You can't file an EZ. If an LTPT ends up working over 1,000 hours, we talked about this earlier, they still get that 500-year vesting service credit. This is my last slide here. So, you know, if you do have an LTPT, they have to receive a slew of materials. So this is just to note enrollment materials, which the record keeper or NOVA can help with. There's fee notices, investment alternative notices, the summary plan description, and if you're a safe harbor, they should be given that notice as well. Okay, so I think I went 1 minute over. Yvette, I will turn it back over to you.
Alrighty, perfect. Just a few reminders to everybody. If you go to your go-to panel on the right-hand side of your screen, you're going to see a drop-down for handouts, and that is where you're going to find a copy of today's presentation. If you are not able to see this on your panel, you can email us and we will send those handouts over to you. For any other questions, you can email us webinars@nova401k.com. Thank you so much, Kim and Kristen, for your time today. Thanks again to everybody for joining us. We hope you enjoy the rest of your day. Bye.